Hey, okay. Thank you for everybody for tuning into today's episode of Capitalized Podcast. Today we have a special guest. We have Gagan. This is one of my great friends. I actually was able to meet with him when I went to New York City. Met with him. We got some food. Great guy. Learned a lot about his background. He has an exciting startup, Decipher AI. He's also a real estate investor. Overall, interesting guy. So, Gagan, you have the mic.
Yeah, thank you so much. So Olu Anifemi has been a great young investor that I've been really excited to meet over the last 4 or 5 months back is through a common friend. But yeah, I'll quickly introduce myself. My background, I'm an engineer by training,
Yeah.
and worked in like embedded systems, electronics for a few years. Then I went to business school. I went to Columbia. I graduated and I started like moving towards financial engineering from
Okay.
electrical engineering. And then I decided to work as a trader. So I started off at Merrill Lynch initially. Then I worked at Bank of America after the acquisition. I moved to Goldman Sachs for a few years. And then I moved to a French bank called BNP Paribas, where I was running all of their foreign exchange
Wow.
and emerging markets trading in the Americas. So that was pretty much my career. Then, got my green card in the meanwhile a couple of years back. I always
Yeah.
had this entrepreneurial bug in me, and I was like, this is the perfect time for me to go and start something of my own. And decided to look into real estate. So I started investing in real estate about 4 or 5 years back as an LP, and
Okay.
I'd always
Wait,
been
can
interested.
you
And
can you explain what an LP is for those that
yeah,
aren't too
sure,
familiar?
absolutely. Yeah, I mean, effectively, one of the most common structures in real estate investing, and especially commercial real estate and multifamily in particular, is syndications. And so the way they structure it is that there is a general partner, a
Yeah.
sponsor, who pretty much is responsible for the day-to-day operations, for property management, and what they do is they actually raise equity partners, and those passive equity partners have a different share class, which is, so they're limited partners. So they're
Yeah.
limited in the sense that their liabilities are limited as well, right? And they tend to be typically senior in the capital structure. They tend to have a pref return. And after that pref return is sort of paid off, that's when GPs can typically have some sort of a carry, right? A promote structure, which
Yeah.
can be a split in terms of any 70/30, 80/20. You have different kind of splits for GPLPs post pref returns. So yeah, so LP is basically like a passive investor who is not actively managing the property on a day-to-day basis, but they still
Yeah.
have an equity stake in it. And so that was a great way to actually get involved. And then when I sort of decided to leave, I was I was like, okay, this is it's basically you need to understand real estate and you also need to understand finance, right? You need to understand a little bit of both. So the finance part was came easily to me, right? Like
Yeah.
underwriting, thinking about models, thinking about risk distributions. In fact, the way we thought about things, risks in on Wall Street, I want to say is a lot more complex, and I feel like bringing that complexity now is an advantage, right? Because you
For
can
sure.
think about, see, I talk to a lot of real estate investors, and they'll always talk about returns. This is what your IRR is, or this is what your equity multiple can be. But if you talk to anybody on Wall Street, right, they will always talk about risk adjusted returns, right? Returns are great, right? But what's the risk reward? Yeah. So there are things like metrics
It
like
cut out.
Sharpe
I'm sorry.
ratios. Yeah.
I'm sorry. The recording cut out for 5 seconds. I could not hear you. Could you just repeat what you said? Sorry.
Yeah, yeah. So I was saying that, for example, in real estate, most people you talk to, they tend to focus so much purely on like rewards, right? Like, what is
Yes.
your IRR? What's your, cash on cash returns, equity multiples? These are all returns that you calculate based on your pro forma, right?
Yeah.
But that's just one singular sort of measure of what your return can be, right? But there are so many other sort of scenarios that could play out, right? So whenever you talk to a trader, right, a trader will always talk about like risk adjusted returns. So they'll always think in terms of probabilities, they'll always think in terms of expected value, right?
Yeah.
So for example, if you go to a hedge fund, right, like a hedge fund will always track something called a Sharpe ratio. right? A Sharpe ratio is a way where they measure uh, what a particular portfolio manager's returns are, but also what's the sort of standard deviation of those returns. So if somebody can produce really high returns with very low standard deviation, that means they can produce a lot of returns and they can produce it with a fair amount of certainty, then you want to allocate more capital to those kind of portfolio
Yeah.
managers versus, you give it to somebody, but then their returns vary so much, right? For the same average returns, if your variance is a lot, then that's a, that kind of investment is less preferred. So I'm just saying that there are a lot
Yeah.
of ways to look at things, which on Wall Street you look at, and I brought that, to my own sort of investment thesis and to decide. But then I've partnered with people who are operational experts, right? Like they
Yeah.
understand real estate better than I do. So that's what the other thing is. You should know your weaknesses. You should know where others can come and complement your skill sets, and and that makes you better as a cohesive team.
No, for sure. I remember we talked about this at least back when I met you in New Jersey. We went to
Yeah,
get dinner that day. I was talking about the 2021 when the interest rates were going high and the cap rate compression that was happening in that period. And you said Wall Street knew something was going to happen. You said the whole Wall Street predicted that completely. It was obvious to you guys, but at least from a real estate side, on the real estate side, a lot of people were blindsided. A lot of people didn't understand that
yeah.
or see it coming.
Exactly, exactly. I mean, if you see hedge fund returns, like macro hedge funds, and if you see like returns for like all trading desk investment banks and all, they had record years like record months and all, because everybody was paid rates. Because the thing is that on Wall Street as a macro trader, you are taught and you're prepared to look at forward-looking indicators, right? You
Yeah,
look at things like what's happening to um, in general, like supply demand dynamics, what's happening to net employment, right? Because like if like NFP and all, like non-farm payrolls, you look at all these forward-looking indicators, and then you also see what's happening in terms of overall global interest rates, right? And supply chain, like that's what happened in post-COVID, right? There was, first of all, interest rates went to zero, right? And
yeah,
then the second thing happened was that there was a lot of like supply chain imbalances that were created because disruptions that were happened because of COVID. And all these things, what they were doing was they were actually raising prices of goods, right? Like if you looked at a car, if you went to buy a car, cars weren't available, so you had to
yeah.
pay whatever
A
20%
premium.
through MSRP to buy cars. What is that? That's inflation, right? So once you start thinking about all those things and you start seeing that, okay, all of a sudden people needed to hire, right? And they had to pay people like higher wages in order to come into work, right? That means that there's again inflationary things that were coming into play. So once you saw all of that, you could see that inflation expectations were going higher. And this is what
Yeah,
like Wall Street looks at, right? They look at things like break evens, inflation expectations. So these are all forward looking metrics. And when they saw that, they were like, okay, rates have to go higher, right? So it's not, and on when you talk to like real estate guys, they'll always talk about what's where rates are right now, right?
yeah.
Versus macro investors are going to always talk about
The
where
future.
rates will be in a year's
Yeah,
time, where they should be. And like everybody on Wall Street was paid rates, right? Everybody was paid rates. Everybody was like, and they made most of the
a
macro
lot.
funds had like 30, 40, 50% returns that year,
Wow.
100% returns, right?
Wow.
This is a lot of people in real estate. In fact, like majority of them lost money,
For
and
sure.
it was purely because they were fixated only on the operational part of things rather than taking the step back and looking at the capital structure as well.
Yeah. After you told me that, I did a lot of digging in and research into what you said because, at least for when the next coming of situation happens, because the cycle's probably going to repeat itself in the next 10 years.
Right.
At least just to have that information, just to be able to
Yeah.
understand it.
Yeah, exactly. And you know what? Every cycle is different. Like right
Yeah.
now, you need to be, now everybody gets so tied down that everybody wants to be like, you know what, we're going to be in fixed rates only, right? Fixed rate, this thing. I'm like, sure. But the thing is that, you want to make sure that if suddenly the global economy starts to look a little bit more fragile, like what's happening right now is that the AI bubble is keeping the whole economy afloat, right?
Yeah.
But if you start to see what's happening in manufacturing and other things, that data started to crack, right? So if the moment the AI bubble sort of like fizzles a little bit, you could actually have a pretty significant like slowdown. And what that means is that rates are going to come off aggressively. So right now, if you actually are getting into like fixed paid rates kind of a thing with like yield maintenance and all, and you expecting that rents are going to go up by 3 to 5%, you could be actually in a very different kind of predicament like 2 years from now,
For sure.
because what happens in global slowdown is there could be layoffs, there could be other things that, and also it's going to be disinflationary, so rents might not go as high as people think they will. And also what happens is that the Fed will have to cut rates more aggressively to make sure that they actually give impetus to the economy.
Yeah.
So you don't want to be locked into like high paid rates in
A
that
fixed
market,
rate.
right? Exactly. So like the kind of structure that would probably make sense in this kind of market would be to look at like floating rate mortgages with caps, right?
Yeah.
Because you want to be in a position to actually take it on. So the thing is that you need to have a macro view, is what I'm saying, to be able to express these kind of things. And there's no one size fits all in every sort of this thing. So
At
that's
all.
one thing that I've learned, and I think that a lot of people can do in real estate better.
It's actually quite funny that you said that you should be exploring that to use a sort of floating rate option. Like I actually wrote a paper on this. At least I
Well,
don't know if you look at my
nice.
LinkedIn. I don't know if you look at my LinkedIn at all.
Well, I
But
do.
at least
You've
I've
seen me.
yeah.
I've always like, yeah, you put up good stuff there. Yeah.
So
No, I
I
think I
was
totally, yeah. You have to
yeah
think
no I
ahead, right? You
for
can't be
sure.
locked into what things happened like 2 years back. You have to think about what's going to happen now.
Yeah, no, because quite a lot of people I've talked to, at least in the real estate sector, they're so fixed on okay, let me get fixed rate debt on this fixed rate debt.
Yeah,
But at this point, this is the time you should really get in bridge debt, in my opinion, with the cap, because
yeah,
as they keep continually cutting interest rates, as that keeps happening, this is the best time to be in real estate, especially the chance you can sell quickly. Also,
yeah,
is
yeah,
interesting.
exactly. No, I'm actually like net. I also think that you're right. That in general, like I think the Fed's probably like maybe gonna like wait for a little bit, but still,
Yeah,
the chances of them like cutting rates is much higher than them raising
for
rates
sure.
in the foreseeable future, right? So that's one. But also second, if you start looking at the overall supply demand dynamics in multifamily in particular, I think that starts to look pretty attractive as well. Like like right after COVID, you saw this like wave of new development that hit the
Yeah,
market, right? And that's actually like hurt a lot of the multifamily
existing.
markets quite a bit, right? Especially in Texas, like
Yeah,
Austin, a
in
lot of places
Houston,
got hit pretty
Dallas.
bad. Sunbelt, yeah. But I mean, the thing is that like absorption is still pretty good, right? And I
Yeah,
think now, if you look at what's happening over the last year or two, there's been like no new starts, right? So effectively, the forward looking supply demand starts to look very attractive for multifamily, right? You'll start to see a fall off in new deliveries actually coming into market over the next year or two, and that's going to bode well for people who get into the market at the right time.
I agree 100%. Would you say, at least based on what you're seeing in the market, that this is a great time to get into multifamily? At least if you have the right capital structure and have the understanding behind it.
Totally. I mean, I started looking, like I said, right? Like, it's been like a year and a half. I've been looking at so many multifamily deals and all.
Yeah,
And it's been hard, like, because um, effectively, like, if I look at a lot of things like, okay, what's the, like cap rate spreads, right?
yeah,
Everything in public markets, everything is a spread, right? Everything is a spread to treasury, right? And you can think about any credit market, right? Everything is a spread to treasury. And when that spread is too tight, that means there isn't enough risk premium to it, right? So when I'm looking at like multifamily, I'm looking at cap rates as a spread to the 10-year treasury, for example, right? And that spread was super tight for the last year and a half or so, right?
yeah,
Now I'm starting to see that actually diverge, and that's happening from both ends, right? Like obviously treasuries, like 5-year treasuries and all, have rallied. Like that means the rate yields
yeah,
have come lower as the Fed has started cutting rates. But also the second thing is that cap rates are actually higher, right? Because what's starting to happen is that
they are
a lot
expanding.
of these, yeah, I mean, a lot of these things haven't been clearing for a while. Now, finally, people are like, they've started to clear a little bit more, but they're clearing at like, worse prices, right? So people have
Yeah,
finally
they're becoming realistic.
manage
At
their
least
expectations and they're actually selling it at lower prices. I'm seeing a lot of distressed deals and all going through right now.
likewise.
Yeah. So if that's my point. If you can get into like a 7 cap deal and you can fund it like with a 5.25%
Those attractive spread.
Freddie agency debt kind of a thing. That's good leverage finally,
Yeah.
right? Otherwise, people are doing all these negative leverage trades and all, and then you are like totally depending on
The market.
operational excellence to actually deliver returns, which becomes very, I don't want to be in that predicament. I want to be
At
like,
all.
what, I have enough carry in it that even if my business plan doesn't work, I'll be able to give my investors some returns, right? But I'm fairly confident that this business plan will work. And in that particular case, they should get outsized returns. And that's how you need
Yeah.
to think about it, right? How do you protect their downside as well?
Yeah. That's you explained it perfectly, honestly. Like if you the way if you structure it like that, like let's say you get a 5% interest rate and you have a 7%, let's say you buy that 7.5 cap, you have enough spread right there, and there's a little cushioning, so you it doesn't have to be perfect. You're not forced
Exactly.
with the plan has to be perfect. You're
Exactly.
not praying you can sell it at a 5 cap or a 5.5 cap for you to be able to make the returns
Exactly.
you promised your investors.
Exactly. And that's what like I see a lot of people do wrong, right? Like, they go go into like these negative leverage trades and all with the whole this thing that okay, you know what, we have to deliver on this business plan, whether it's value add or whatever else. And if they fail to do so, right, if they can't raise rents enough and all, then it's like, an epic failure. You can lose so much in
Yeah.
terms of
It'll kill the
but
deal, you
I
lose
mean,
equity.
that's what I was talking about, risk adjusted returns. So that's why it's important to know what the risk is in any investment.
Yeah, it's actually quite funny that we actually were looking at the same deal at the same time, but we didn't before we even knew each other. It was a deal in Houston, Texas. I think it was a 120 unit deal, and we both were looking at it. We both underwrote the deals. We both have seen the deal. We both like the deal a lot. We ended up passing on the deal. That's funny, honestly.
um Yeah, no, exactly. It was so weird because it's like, it's for both of us to have looked at the same deal, priced it. Uh,
Priced it. We
yeah,
both had the same sort of conclusion against about it.
exactly, exactly. So, but yeah, I mean, that's what great minds think alike. That's all I can say. But I mean, I feel like this year for sure is going to bring a lot of opportunity.
Yeah. Like I tell my brokers all the time, at least the one I'm talking about. This is the year I truly want to be aggressive in the market. I believe aggressive. I have a bridge lender I'm working with, so hopefully that will help me on that point. But just to be aggressive in the bridge space, buy all. I've seen a lot of distress, honestly. Like I don't know you on your decisive if you looked at any of the deals I've underwrote. Like there's a deal, the Allegria deal. It's 600 units at a $40 million basis. That's almost unheard. That's almost unheard of,
I'm so sorry, but yeah, I mean,
especially in the. Are you okay?
it's so funny because this is I over the last like seriously
Hello.
over the last 3 to 4 months, all of a sudden I've started to see like so many distressed deals come to market. It's yeah, and that's why I'm very very excited. I feel like over the next 3 to 4 months you'll find like a lot of good opportunities.
Yeah.
Sorry, so sorry about the technical difficulties, man. No, but I was just saying the same thing. I was like, yeah, I think there's a lot of distress that's finally that's clearing now, and
Yeah.
it just makes it like if you're a patient investor, this is exactly what you were waiting for.
For sure. For sure. Like they've been talking about distress coming online for the past maybe three-ish years. Now I'm sort of. I haven't really seen a lot of distress. I've seen a lot of bad deals that are mispriced, but now it's actually the banks are trying to sell the deals, honestly, and it's
Exactly,
becoming more attractive.
exactly, exactly,
Yeah.
exactly.
Yeah. So, at least your investment strategy, can you outline that? Like, what do you specifically look for? Is it only multifamily, or do you look at other type of deals, or what in multifamily?
So I started looking at multifamily. That was my first like go to, and because I'd already invested in multifamily as an LP.
Yeah.
But for me now it's like any deal like which cash flows really well, where there is a clear business plan, I'm interested in. So the one of the few deals that we actually did was a hospitality deal, because just
Okay.
because like in multifamily cap rates was still like like low six, even five handle kind of a thing. and with rates as high they were, it just wasn't as interesting for me. And then in hospitality, I found a deal again with an operator who's got like a lot of years, decades of experience in hospitality. Um, but we found a deal which was almost a 10 cap, right, for a
Wow.
class A kind of property, right?
Wow.
And there was room for us to come in, and it wasn't like a massive like value add and all, but there was like slight, there was a pip that you could come in, and then there was also like a operational sort of upside kind of a thing where you could come in and drive NOI higher by doing some operational changes. And that's why it made it super attractive, right? For me, it was like something that had like 3.5, 4% kind of like positive leverage and had that kind of upside. So that's why I was like, I don't care. Like, I'm not like married to multifamily. Multifamily is where I focused most of my attention.
Yeah.
But wherever you can get really good returns, you want to focus on that. So I've also started looking at assisted living. I've looked at like, a few other asset classes as well. But still waiting for the right opportunity, to be honest.
Why do you look into multifamily specifically? What is so compelling to you in that
So I think,
space?
yeah, I think multifamily. I think the thing is that it's like, first of all, it's pretty much like 50% of CRE is multifamily, right? So there's
Yeah.
just like the asset class itself is
It's
huge.
huge.
Yeah. Second, it's almost like, the investment grade. If you're investing in like, in credit, right? It's almost like the investment grade equivalent, right? The way I like to think about it, right? So if you're thinking about some of the other asset classes, there's more risk to it versus multifamily, like, class A multifamily and all. It's always going to cash flow. People are going to like, even in a downturn, right? You can actually see office gets hit so much, retail can get hit so much, kind of a thing. But multifamily, people need to live, right? People will still pay their rent and whatnot. So it's actually one of the safest asset classes in that regard. So that's why it's interesting. And then the third is that because it trades at a lower cap rate, and there is a lot of times there is opportunity to drive NOI significantly, whether it's
Yeah.
through value add or whether it's through some other operational like changes and all. So the return you get for that change in NOI is the highest in multifamily, right? Just because
Yeah.
the cap rates are kind of low. And that's why I feel like you can actually drive a lot of return, like you can force a lot of
You
return
can
for your
control it.
investors in multifamily more so than in other asset classes.
Yeah. But obviously, somebody like you that has a deep finance background. Why didn't you go sort of the hedge fund or trading route?
No, actually, I
Why
did
do you look
trading.
for
Like I did
commercial
the
real
trading
estate?
route for like I know did that for like around 17 years, and then I thought about a hedge
Wow.
fund. I considered it, but the thing with a hedge fund is that it's still, you could be very right about things, but there is still like so many variables that you can't control it, right?
Yeah.
So you have a view, you put on something, but then like suddenly like there could be a war somewhere, there could be like a presidential tweet, there could be some tariff thing comes out, and things are out of your control, which can actually ruin your returns, right? These things you don't control.
At all.
Versus in real estate, I feel like if you think through your capital structure, if you have a strong business plan, then I feel you actually control your returns much better than you do so in actual, in a hedge fund seat. So that's why
Yeah.
I was like, okay, if I'm going to do a fund, if I'm going to go invest money and all, I feel like I have a higher probability of succeeding over a long period of time doing this versus trading like whatever rates and FX and bonds. So that's the reason.
Yeah.
Because like even at the best of traders, I want to be right like 60-65% of the times. But if you're like a good strong real estate operator, you can probably have like a 90% success rate, even
For
higher.
sure. For sure.
So
Especially because it's a stable asset that is tangible.
it is
Like
tangible,
no,
exactly.
nobody can just get rid of your investment. Let's 200 unit multifamily. Nobody can get rid of that tomorrow. Like,
Exactly. Exactly.
yeah. Wow. So what is your investment thesis like? What in multifamily do you look for toward? Like typically, are you a more class A, B, C type person? 1980s, 2000s. Like
So, I mean, of late, I've been like I said, right, I was talking about what kind of cap rates different asset classes have been trading at, right? So, in multifamily, one of the things that stands out to me is that so many people went for the workforce like class B kind of properties and all, that if you see the class B, class C properties versus the class A, like the spread in cap rates over there is narrower than it has been, you know over the last, it has kept compressing over the last decade and a half. So for
Yeah.
me right now, you can buy a class A asset in some markets at 6% cap, right? And you can
Yeah.
get a class B at like six and a half, right? So I would almost want to be in a class A kind of a
For
market right
sure.
now
At that in that
than a class B.
situation.
The only thing a class A kind of thing is also you have to be cognizant of the supply demand effects and all that, right? Because a lot of the new property is going to be class A as well. So what are the supply sort of dynamics in a particular sub market? So there's more than one things that go into it. But for me, I think the biggest things have been where there has been a clear sort of uh, you know uh, impetus to be able to boost NOI very easily. For example, there was one deal we looked at in Virginia, which was, we came very close. We put in a very strong offer, went to best and final, but we lost out in the end. But the
Wow.
thing over there was that it was it was almost 100% occupancy. So very, very strong performance, operationally managed excellent. But there was a huge, there was in the basement, not the basement, actually, the ground floor they had, the first floor, there was this massive, ballroom, right? With
Yeah. Oh,
art,
you mentioned this
art.
deal to me.
Yeah, I did mention it to you. There was art
Yeah.
all around the walls over there. It was really, really nice. And the owner, it was like a mom and pop kind of a run establishment. Like 4 or 5 years back, they used to actually have weddings over there in that particular space, and just from that, in 1 year, they'd made like more than $150,000 in
Wow.
NOI, right? And then they had never done any of it, right? So you were actually buying something for like almost like a 7.5 cap, with this particular thing not even built into it, right? So you could come
Wow.
in and you could suddenly, this so it was a way for you to come in with no capex, nothing, to come in like suddenly just spend some energy, find a property manager who could actually go in and bring in like some event management kind of thing, partner with them, do a revenue share or whatnot, and suddenly you should be able to boost NOI by 150K. Those kind of things make me very excited, right? Where there is already, it cash flows really, really well, but then there is clear ways for you to actually come
Clear
in and
upside.
boost NOI, whether it's value add, whether it's something else. Uh, but yeah, those are the kind of deals that I really, go towards.
Yeah. No, I agree with that. Just a deal that has existing upside, and also the claim you made on the cap rates being similar, like between a class A and class B. I feel like at that point, if it's like, let's say you can buy class A at a six, and you can get a 1980 deal at six and a half. The class A is extremely attractive at that point
Yeah,
because just
exactly.
you
If you can get
less
a
maintenance
20,
cost.
exactly. If you can get a 2020 build versus like a 1980 build, and
It's a
for
no
a,
brainer.
whatever, 25 basis points difference in cap rate, I mean, it's like, you always go for the new one, right?
For
Over
sure.
the next 10 years, the 1980s is going to still give you a lot of grief in terms of repairs and maintenance, other costs and all, versus this one, right? So it's going to be like a easier deal to manage for sure. So I think, yeah, those
Yeah.
things, those factors uh, definitely come into play.
Yeah, no, because I want to break into the Class A space. I don't always want to focus in Class B, Class C, just because there's a lot of you have to worry about lesser tenants, you have to worry about other issues, operations, you have to worry about maintenance costs, tenants ruining the property. With Class A property, the maintenance costs are significantly less, but
Yes.
the cost is significantly higher. Like I don't know where you look at deals. Are you look at deals all over the country, right?
I do. Yeah. So because again, like I
Okay,
said, right, like when I was starting out, I was like, okay, it's also about like, the more you look at deals, the better sense you have about like when you see a good deal. If you've looked at 100 deals, the chances of you like, identifying a good deal is more than if you look at three, right?
for
So
sure.
you build your whole like sort of level of the perspective. Same thing like in trading, right? The more deals you price, the better sense you have of the market. So you know when there's an opportunity. So for that reason, like I price deals everywhere, right? Like in Indiana, in uh, Ohio, in the Sun Belt, Tennessee, Florida, everywhere, right? So just because you get to know the nuances of different markets as well,
Yeah,
and and then you can form your own thesis, right, in terms of which markets do you want to be in, which and even then, like if you find a really good deal in a market that you didn't think you want to be in, if it's a good investment opportunity, why not?
For sure, for sure. I don't like. What's your thoughts on vertically integration? Would you ever approach that?
I think it makes a lot of sense, to be honest.
To
In fact, at the Saif, like one of our first clients is like an ex Goldman colleague of ours, and he actually started his first fund. His thesis was that unless you can actually control operations, right? Like actually control operations, it's a slippery slope. So even if
yeah,
you actually hire a good property manager, right, it's still not the same, right? Like for you to be able to control it, I know some people are doing it very successfully, but then they are excellent in terms of finding the right property managers and like
in price.
building a relationship with them and all. So it's almost like they're vertically integrated. But I feel like if you are and you can control that, you have that whole sort of network built in, and you can sort of cross pollinate along your different properties and all. I think it makes a lot of sense.
To vertically integrate.
Yes.
Yeah. No, I agree. What I've heard, because I'm exploring it currently and trying to
Hmm.
at least have vertically integrated portion of the company, is just it without a certain amount of scale in a certain area, it's just not affordable. It doesn't make sense. At least
Absolutely.
for
I mean,
what
it
this.
takes a certain amount, you can't really start off with one property
Yeah.
but the thing is that the moment you actually build scale, right, I think then it makes
It's
sense.
perfect. It's
Yeah.
essential.
Yeah.
It gives you more control also.
Absolutely. Absolutely.
Yeah.
Yeah. Plus, I think the more you, the more you understand how things are operating on a day-to-day basis, the better you get in terms of underwriting new deals as well. Which
Yeah.
is like our whole thing we were talking about at Decipher, also our whole model in terms of using your own portfolio data and all to be able to get signals for your future underwriting, and I think that's very important as well.
I agree. Can you explain what Decipher is? He has an amazing AI software that I use for
Yeah.
my underwriting. A lot of people have used. It's amazing. Explain it,
Yeah,
please.
no. Thanks. So basically when I started like underwriting deals for myself, I was like, you know what, now with technology, you should be able to automate a lot of this, right? So the whole idea behind it was like automate parsing of like rentals, T12s, CoStar reports, OMs, and to be able to populate your entire model to build it out, right? So we do that already. And then the second step is also now you want to be able to look at all your portfolio data, right? Like if you have some 70s properties, you want to be able to track, what's your repairs and maintenance for only your 70s properties, or how is your all your Georgia properties doing, or something else, right? So basically get signals from your portfolio. But the reason we are taking this step by step approach is that our goal is that we want the underwriting software to be able to be like a junior analyst on your team, right? So you send it a deal, you email it a deal, and it'll be able to analyze it, identify all the red flags, look through like, okay, what are the opportunities set over there, identify all the comps, look at the market, to be able to see what the supply demand dynamics are, net absorption is, and then to be able to come up with its own optimal sort of capital structure and a business plan. And then it just makes it easier for you to be able to do all of that. And then the goal for the human would be to be able to verify all the assumptions, and then to be actually present at the property, visit things, and then to be able to call up DAX and say, decide, be like, hey, you know what? The capex budget on this is probably going to be higher. The exterior needs a little bit more work. So let's add
Yeah.
100,000. What does my underwriting look like right now? And it'll be able to text you back and say that, hey, IRR will drop by this much, and this is what it looks like. So that's the whole plan needs to be that it's you talk to your underwriting, right? You actually have somebody. You don't need to be sitting over there in front of a spreadsheet all day, right? You need to
Yeah.
be thinking about like, okay, is this a good deal or is that a good deal? And also it should enable you to if you're looking at three deals right now, right? Great. But like I said, the more deals you look at, the chances of you finding a gem are higher, right? So
For
with
sure.
this, the whole goal would be you analyze 100 deals a day, right? If you can analyze 100 deals, because the AI can keep working on it, right? Every deal that comes into your
24/7.
inbox, it can keep pricing it up, come up with the whole thing, and keep flagging to you like, okay, this is a good deal that you should look at. And then it just you start looking at deals that actually have they fit your buy box, right? And that's the goal really, right? To be able to help investors find the right opportunities.
Yeah. Wow. No, I've used Decipher a lot. I like it. It saves me a lot of time, honestly. Like I was
Yeah,
considering bringing on another analyst onto my team, but with Decipher, it's sort of they do a lot of the work that the analysts would do.
no, exactly. And that's what, right? And the thing is, we're starting off right now, but the thing is, we are training it on day, and you train it yourself. So
Yeah.
we'll, like certain things, like already for your chart of accounts, you train it, right? It's like so this is called reinforced learning in AI, and there are a lot of other things also we'll have, like where you actually say, okay, I want this kind of analysis, I want to see more of this. So the thing is that the model learns to think like you, and that's the goal, really, right? So uh, you know your model is going to be very different from somebody else's model, and that's the idea, right? It thinks like you.
Yeah. Wow. And this is just you and Payush, right?
Yeah, exactly. So
Yeah.
Piyush is like he is a quant at he was a quant at Goldman Sachs, and
Yeah.
he's a Carnegie Mellon like math finance major, and yeah. So the two of us have been
It's an
building
excellent
it.
duo.
Yeah, I mean, to be honest, he does most of the coding kind of a thing. He's the CTO. He does like this thing. I help in as much as possible, but my role is more about like product and features and uh, thinking about like how it can transform things.
Yeah. No, I feel like you guys complement each other a lot. It was great meeting Payush also.
Yeah, exactly. I
Just
mean, that's
seeing,
what any good team is, right? You need to know, like, okay, what kind of skills, like, do people, different people bring, and then,
yeah.
like, work cohesively as a team. And that's the best part.
No for it. So what are your goals for, let's say, what are your goals for Decipher and then for your investments?
So for Deciph, I mean, our goal is to broaden our reach. Right now, we have we're working with a lot of GPs. We've started to work with a lot of our clients are already vertically integrated. So that's why we started working with the asset management teams and all as well. Uh, but I think the goal is now to actually go just from GPs to be able to help lenders and all as well underwrite, right, from the debt side, because the whole idea for me is the more data we get and the more deals we analyze, the better the model is going to become, right,
Yeah.
for everybody. So when you are analyzing a deal in, say, Houston, you'll be able to benchmark it to a lot of market level data that we'll aggregate, right? We're not going to we anonymize data, but we create benchmarks from aggregated data. But that
Yeah.
aggregated data helps everybody who uses the platform, kind of a thing. So our goal is to do a lot of that, and then to scale it and to to go after like bigger clients. So that's the goal. But for the the thing is that we've been investing already, and finding like right partners, operating partners, and like finding good deals and investing in them. I feel like this year our goal is to be able to do at least three deals.
Yeah.
We did one this year because the opportunity set wasn't there, and that
It
also
was
was in
limited.
hospitality. Here this year, I feel like multifamily is going to be a good year for multifamily investments.
Yeah.
So I'm really focused on that. Maybe one assisted living deal also, because I feel like
Assisted
the
living.
demographic story over there is pretty I think a lot of people have gotten into it, but I still think that there is room, and for especially like in some of the markets where there is higher barriers to entry.
Yeah.
I think assisted living can be pretty interesting.
Yeah. No, I've heard the assisting living played by a couple people. Actually, the week I went to New York and was able to meet with you, they spoke about
Mhm.
it. At least there's a big opportunity for assisted living in like higher income areas that are in like
Exactly.
middle market, like the suburban areas that don't have it, that are
Exactly.
median household income is like 100,000.
Exactly.
That's a
And you know
perfect
what?
area to
Like
put
some
it.
places, like in New Jersey, where I am,
Yeah.
you need a certification of need, right? So you need to actually get a CON from the state, right, from the city, before you can actually start one. So
Really?
I know it's like, so there's a barrier to entry. So, but the thing is that once you buy an assisted living over there, you know that there's nothing else coming up. Not like
Yeah.
multifamily where there could be like a lot
You
more
can pop up
supply.
like this.
Yeah, exactly. Plus, like, like in New Jersey, again, like, you're very near, like close to Manhattan. So a lot of the like rich neighborhoods, like ultra wealthy people don't want, people who are working on, say, Wall Street or high tech companies and all, they want their parents, their loved ones to stay close by. They want to visit
Yeah.
them with their families over the weekends. So I feel like, that's why places like in New Jersey and all, they're like almost like always there's a waiting list.
Really?
So that's why I like, I think that's a good investment. You can have like really solid returns for the next decade or so, because the demographics, it's clear, right? I mean, there's a silver tsunami and like all the aging population. You're going to need more and more memory care, assisted living kind of spaces.
Yeah. Wow. Have you jumped into data centers at all, or not? Or doesn't really interest you?
I looked into it a little, to be honest. Like, I started looking into it, but yeah, I mean, you tell me if you find something good, we'll have a look at it together, man. But it's one of those things that I feel like, I think there's an investment opportunity for the next few years. I just worry a little about, like, how much money is being spent in data centers right now, and like for
Yeah.
a lot of it is going to be so redundant. So once people don't see the ROI, what happens then? Like, for example, like, Oracle, I don't know whether you followed, like Oracle announces partnership with OpenAI. The
The
stock went
two
like,
hundred billion.
crazy. Yeah, exactly. And the
Yeah.
stock went like massively higher. But then over time, like, it's completely reversed all its gains. And also, like, there's something called a CDS, which is like a credit default swap, which basically measures the probability of default of a particular company, right? So that CDS has started to show, like, it started to trade much wider, which means that the market is now getting worried about Oracle, like, not being able to pay all the debt that it's actually taken on to fund these data centers. So that's why I feel like, like people are getting into data centers from a real estate perspective, being like, hey, everything
It
is hunky
looks
dory. But
amazing.
like,
Yeah.
like the person in me who's also like, who likes to look at like two steps ahead, looks at all these things. And I'm like, okay, let's just be a little cautious. I still think that it's a great opportunity for the
Yeah.
next 5 years. There's going to be a lot of money in it. But I also think that after that, there's probably going to be some pain as well. Like, some of
For
the people
sure.
will probably not get the ROI they thought they would. And I think then it's going to be like you'll see defaults and all that. And so it could get a little messy maybe in 29, 2030 kind of time frame.
Yeah. I think it's essential. Like there's different types of asset classes when it comes to data centers. Like there's the mega ones that are owned by companies such as Meta, Tesla. Those ones are secured under, let's say, a 30-year lease with dividends. It's extremely, you know what I mean? Those are more attractive, but then there are the single ones that are like owned by individual operators and are leased out on that way. I'm not too familiar. I'm not too familiar in the space, but I've seen a deal recently. Somebody has a farm in Alabama. It used to be a manufacturing farm. I think they closed it down. They're going to convert it into a data center. It has a power station right next to it. I think a 50-watt power station right next to that leads directly to the place. That's like things like that are still extremely interesting,
I agree. I agree. I
at
think,
least in
yeah,
the
I
data
mean,
center.
there's definitely interesting. I haven't really found any, like, to be honest. I looked a few months back. I was looking for some, but hard to come by, right? They're not that easy to find. They're
Yeah,
not listed that much. So, but
at
yeah, and
all.
also if you have a good partner, then I think, yeah, I would definitely get in.
Would you ever be interested in, like, let's say, a conversion, like office to resi conversion? Would that ever interest you?
Yeah, for sure. I think there's like, I mean, it's a tried and tested, like, and also like with office, a lot of what's happened is like, given that some of these offices are pretty much lying vacant right now, I know that
Yeah,
some of the towns are actually giving you tax incentives to do that. So
yeah,
forget about everything else. So you can actually have a really good, like, change, and, you can create like workforce housing where it's really needed. So you actually have something which is going to have a social impact, but also you can actually get tax incentives for it. So yeah, I mean, I would definitely. I think there's. I know. In fact, I know some people. I've met them at conferences and all, who've done like done really really well in that space,
really.
conversions.